There's a moment that happens when someone becomes wealthy. Not famous wealthy, just comfortable. They stop thinking about their savings account. Not because they're careless, because it stopped mattering. And if you've ever tried to save money seriously, this probably sounds insane. You know exactly how much is in your savings. You check it. You think about it. You move money around to make the interest work harder. But here's the thing. The richer someone gets, the less their savings account does for them. And that's not a personality trait. It's not about discipline or values. It's about how money actually works at different scales. Most people assume the financial system is the same for everyone. Same tools, same rules, just different amounts. But that's not true. And once you see why, a lot of confusing behavior around money starts to make sense. Let's start with what saving money actually does. When you save, you're doing two things. First, you're protecting yourself from emergencies. Second, you're trying to grow that money over time, usually through interest. For most people, both of those things matter a lot. If you have $5,000 saved and your car breaks down, that savings account is the difference between fixing it and going into debt. The savings is a buffer. It absorbs shocks. And the interest? Even if it's small, it feels like progress. Your money is working for you. 1%, 2%, maybe more if you find a good rate. It compounds. It grows. So you protect it. You think about it. You optimize it. Now imagine you have $5 million. What happens when your car breaks down? Nothing. You pay for it. You don't even think about it. The repair cost is noise. It doesn't touch your financial stability. The buffer you needed when you had $5,000? You don't need it anymore. You are the buffer. And that's the first thing that changes. Savings accounts exist to protect you from uncertainty. But when you have enough money, you're already protected. The account itself becomes redundant. Let's say you put $1 million into a high-yield savings account. A really good one. 2% annual interest. That's $20,000 a year. Sounds great, right? Now let's compare that to what wealthy people actually do with money. If you take that same million and invest it, stocks, real estate, private equity, whatever, the expected return is somewhere between 7 and 10% annually. Let's say 7 to be conservative. That's $70,000 a year. Same money, different system, $50,000 more per year. And here's the thing, that $50,000 gap gets bigger the more money you have. If you have $10 million, the difference between saving and investing is $500,000 a year. So the question isn't, should I save or invest? The question is, can I afford to take the risk? Because investing isn't safer than saving. It's riskier. The stock market can drop, real estate can lose value, businesses can fail. But if you already have enough money that losing some won't hurt you, the risk becomes acceptable. You can wait out the bad years. You can recover. And that's what wealthy people do. They don't avoid risk. They absorb it. Savings accounts are designed for people who can't afford to lose. Investments are designed for people who can. Why does investment return more than savings? This isn't random. It's structural. When you put money in a savings account, you're lending it to a bank. The bank pays you interest, but that interest rate is low because the bank is giving you a guarantee. Your money is safe, insured, stable. Safety costs you returns. When you invest, you're buying a piece of something, a company, a property, a bond. You're taking on the risk that it might lose value. But in exchange, you get access to the profits it generates. Risk gives you returns. And here's the key. The financial system is built to reward people who can take on risk. If you can afford to wait 10 years, you'll almost always beat someone who needs their money next year. If you can afford to lose 20% without panicking, you'll outperform someone who has to sell the moment things drop. Wealth doesn't just give you more money, it gives you time. And time is what the system rewards. Now let's talk about liquidity. Liquidity just means, how fast can you turn this into cash? A savings account is perfectly liquid. You can withdraw money today, right now. An investment is less liquid. If you own shares in a company, you have to sell them. If you own property, you have to find a buyer. It takes time. For most people, liquidity is essential. If you lose your job, you need cash now, not in 6 months, now. But if you're wealthy, liquidity stops being urgent. You already have enough cash on hand to cover anything immediate. So you don't need your entire fortune to be liquid. You can lock money up in things that grow faster because you're not worried about needing it tomorrow. This is why wealthy people hold so little in savings. Not because they're reckless, because they don't need the liquidity. They've moved past the point where a savings account solves their problems. There's one more layer to this. Let's say you're wealthy. You have $10 million. You're investing most of it, but you still keep some cash around just in case. How much? Most financial advisors will say, enough to cover 6 months to a year of expenses. If you spend $200,000 a year, that's maybe $200,000 in cash. The rest? Invested. But here's what's strange. That $200,000 in cash probably isn't sitting in a savings account earning 2%. It's sitting in a money market fund, or treasury bills, or some other low-risk, low-return instrument that's technically not a savings account but functions almost the same way. Why? Because at that wealth level, even the cash you're not investing is being optimized. The system gives you access to tools that pay better than a regular savings account, but still keep your money safe and accessible. These tools exist, but most people don't have access to them, or don't know they exist. The financial system has tiers, and the higher you go, the better the tools get. So what does all this mean? It means saving money isn't universal. It works differently depending on how much you have. If you're building wealth, savings accounts are essential. They protect you. They give you stability. They let you survive shocks without going into debt. But once you have wealth, the math changes. The risks you can take change. The tools available to you change. And the savings account that once felt so important starts to feel like dead weight. Because you've outgrown what it was designed to do. This is why rich people don't obsess over savings rates. Not because they're careless, because the system they're operating in rewards different behavior. And this is one of those things nobody really explains. We're taught to save. We're told it's responsible. And it is. For most people, at most stages of life. But the system doesn't reward saving forever. It rewards saving until you can afford to invest. And once you can, everything shifts. Most people never see this shift, because most people never accumulate enough to make it happen. And that's not a moral failing, it's just math. The system is designed to benefit people who already have enough to take risks. Once you see that, a lot of frustrating things start to make sense. Why your high-yield savings account feels like it's doing nothing, even though you're doing everything right. Why people with money seem to make money effortlessly. Why the gap between saving and investing feels so hard to cross. It's not you. It's structure. The system doesn't punish you for saving, but it doesn't reward you for it either. And once you understand that, you stop blaming yourself for feeling stuck. So if you like this channel, consider hitting the subscribe button and make sure to like this video if you found it valuable.